Hello, and welcome to another MoneyWeek webinar. This one is called Away from the Index, Investing Off the Beaten Track. I'm Andrew van Sickle, the editor-in-chief of the magazine. Now, when it comes to investing, passive funds such as exchange-traded funds and index trackers tend to be in the spotlight. But the magazine has always been keen on investment trusts, a form of actively managed fund that has tended to perform very well in the past and gives investors easy access to under-researched and potentially illiquid areas of the market. One of our 6 favorite investment trusts is the AVI Global Trust. It's a very unusual, globally focused fund, seeking out overlooked and under-researched parts of the equity market, with a specialist focus on companies trading at a discount to the sum of their parts. Now, with me today to explain the trust's approach are Joe Bauernfreund, the Chief Executive Officer and Chief Investment Officer of Asset Value Investors and the sole manager of the AVI Global Trust, and Wilfrid Craigie, AGT's Senior Investment Analyst. Welcome to you both. Right, Joe, why don't I start with you? Now, AGT doesn't look like a typical global fund. What exactly is the thinking behind your strategy, and what kind of companies make it into the portfolio?
Well, the starting point for us is that stock markets aren't always efficient. And the parts of the markets that interest us are those parts that are inefficient, that are neglected and overlooked by other investors. And those give rise to the greatest price discrepancies and the most interesting opportunities. And extending that a little bit, we want to be different. We don't want to be offering the same funds or the same portfolio as our peers. And in order to embrace those differences, you get a portfolio that is high conviction, that's highly concentrated, and that is genuinely differentiated from both peers and from those passive tracker funds. Typical companies that make it into the portfolio, as you said in the introduction, are companies that have got some kind of asset backing, that are trading at a discount to those sum of the parts values. And it's the size of that discount that starts to give us a feel just as how inefficient some of those prices may be.
So a lot of it is sort of looking out for companies that are under-researched as well, isn't it? Now, Wilfrid, how do you go about identifying these under-researched companies that people just don't look at properly or they haven't found?
Yeah, sure. So, well, we've been doing the same thing for now 40 years this summer as managers of AVI Global Trust. And for that entire period, we've had the same philosophy. And as Joe said, that's really premised on the idea that there are pockets of the equity market that are prone to inefficiency or mispricings. And it's those pockets that we seek out. So over time, we've built up something of an institutional knowledge of the types of company that we think attract inefficiencies. And we've really focused on those throughout our entire history. I'd say over the last maybe 5 years, we've spent a lot of time trying to take that so-called institutional knowledge and really clarifying how we house all that data. So we've developed a proprietary database called the Hub, where we track and manage our various data sources. So we're looking at companies, and as Joe said, their discount, their NAV, their share price, and we can interrogate that. So we'll scan and look at our proprietary NAV models. And as Joe said, the level of discount will often be the first thing that could spike our interest. So we'll run screens on a weekly basis on our models, looking for deviations in the discount. And that will begin to start the research process. And from there, obviously, we go much deeper. It's one thing to trade on a wide discount, but there's much more to it than that through the research process.
You talk about a bespoke system, don't you? I mean, presumably that means there's a lot of research. Presumably you have to go into the field and really talk to these folks to make sure that your initial impression is right. Is there a lot of traveling involved and things like that?
It's a relatively niche part of the market, which is, as we've already said, under-researched by both the sell side, but also really the buy side. So it's on us to get out there to understand the companies, go do site visits, kick the tires, so to speak, go to conferences, meet management teams, and really get into the weeds. So that's really important, as we're looking where others aren't.
I think that it says a big part of your approach is that when you find value, you want to push for change that might unlock it. How do you go about unlocking value through active engagement?
Sure. So I mean, I think every investor nowadays claims to be an engaged investor, but there's a broad spectrum of what that really means. And for some, that's something as vanilla as sending a questionnaire to a company, asking quite quite basic questions, but for us, active engagement means something really quite fundamental, and it permeates everything we do. It's not a one-size-fits-all approach, as there'll be nuances between how we engage with different companies. As I'm sure Joe will come on to speak about in Japan, the way in which we might engage with a company there is different to, say, a London-listed closed-end fund. So we have to be nuanced in our approach to engagement, but at the heart of it, there's a belief that as owners of a fractional share of businesses, we can do steps, take steps to realize and unlock value. So when we're thinking about companies trading at wide discounts, we're looking for reasons that can fix that discount. So it might be capital allocation, it might be communication with the market, or it might be more in, say, in a Japanese small cap company, our approach might be more operational in focus. So we think engagement is really fundamental, and it's a real differentiating factor between what we do and what other investors do.
See that one company you've been involved with is Gerresheimer, is that it? We've actually put that in our German views section because it came up in Wirtschaftswoche, one of my favorites. Tell us a bit about that one and how the engagement worked there.
Sure. So Gerresheimer is a German company, as you say, a conglomerate that's history lies in molded glass. They were in the 1990s, they were the largest producer of beer bottles globally. But over the last 20 years or so, they've developed an attractive business in pharmaceutical packaging. And that's really what we were interested in. And we built a position at the back end of last year, as they hold a very valuable position in both containment solutions, so getting drugs to the patient, but also delivery systems, getting drugs into the patient. And it's an investment where there's been quite a lot of bad news, quite a lot of difficult developments, and that's really stemmed our need for engagement. So we don't engage kind of for engagement's sake, we don't make noise for the sake of it, but where we think there's a risk to value or value being squandered, that's where we really step up, and that's what we've tried to do with Gerresheimer in our engagements with the supervisory board, with the management team, and with other shareholders. I'd say that the jury is still out on the success of our engagement, but this is typical for us to roll our sleeves up and do our best efforts to engage with the relevant parties to capture that value.
I expect it helps if they can see that there are problems with their market as well. I'm struck by the fact that Gerresheimer is one of those sort of structural plays, isn't it, where you've got the drug packaging, you've got that kind of thing. Is that a sort of leitmotif for you as well, looking at companies, or is it not that important?
So I think at the heart of what we do, as we said, we're trying to buy things trading at discounts to the net asset value, but we're looking for situations where that net asset value can grow. So we want to buy a pound of assets for 70 pence, where that pound can grow to be £1.10, £1.20, £1.30. So as you say, in an industry with attractive structural fundamental growth, such as pharmaceutical packaging, that's exactly the kind of thing we look for. We want to own good quality businesses that can grow in value.
Talking about good quality businesses, we've always liked Japan, and I know that's a major focus for you. For ages and ages, we liked it far too early, early enough for us to be able to say we got it wrong. It's long been a graveyard for value investors, hasn't it? But slowly that seems to be changing. Now, what's behind the recent wave of improvements in governance, and how is your fund taking advantage of it?
You're right, it's taken a long time. It has been a graveyard for many investors. But I would argue that Japan has changed, and I don't think it's a question anymore. Will Japan change? It most certainly has changed. The factors behind that change were the introduction of the Corporate Governance Code and the Stewardship Code as part of Prime Minister Abe's structural reforms that he introduced into the market, along with monetary and fiscal stimulus. And these were really designed to get companies to change their attitudes towards shareholders.
That was quite a while ago now, wasn't it?
Yeah, well, they were introduced around 2014, 2015. So it's taken 10 years, as you say. And now we see completely different attitudes towards shareholders in the Japanese market. There are more activist and engagement funds such as ourselves. Those are both domestic and international. And generally, our experience is that when we speak to management teams and companies in Japan, they're much more willing to listen, they're much more willing to engage with us, and they want to hear our suggestions as to what they can do to reverse their undervaluation. And they're getting pressure as well from the regulators. The stock exchange is putting pressure, and nobody's happy with the undervaluation, and everybody's pushing for more to be done to address that.
It was always a question, wasn't it, that minority shareholders were just expected to be quiet, and that was that. Yes, as you say, there's now pressure also from the regulators. I think there was a specific initiative, presumably also from the Tokyo Stock Exchange, that were trying to, have a set of guidelines. So it's been helping to push from above.
Yeah, the Tokyo Stock Exchange looked at the market as a whole, and they saw a huge number of companies trading below book value, and they felt that that needed to be addressed. And they've come up with proposals that compel companies to think about their valuation, and in situations where their share price is trading below book value, to ask them to think about what they're going to do to address that, to reverse that, to actually say what they're going to do. And failure to do so puts you on a name and shame list. So it's pretty powerful. It's a pretty powerful force, really, that focuses the attention of companies.
Naming and shaming does sound very positive, yeah. Having had this push for years, do you think there's still value left? And presumably there's still quite a few companies that have been resistant to this and are still trading below book value and could do with a bit of a kick from you.
Yeah, absolutely. Valuations aren't as screamingly cheap across the board as they were, say, 5 or 10 years ago. But certainly there are plenty of cheap opportunities. It's a market of 4,000 listed companies, which is far too many, which means that many companies shouldn't be listed. And those situations should be exploited either by us or by private equity investors. But the other factor that should be considered is the fact that because the mindset culturally has shifted now, and companies are just more open to pushing for shareholder returns, the catalyst for unlocking value is that much easier to deliver or engineer.
It's like the door's been unlocked.
The door has been unlocked. They're not holding their feet against the door as you're knocking on it. They're actually opening the door and saying, if you've got some suggestions, we're going to listen to them.
Can you give some recent examples of where you've been batting the door open?
Well, we've had a stake in an IT services company called DTS for the best part of 5 years now. This is operating in a part of the market where we saw very good tailwinds for growth. This was a typical Japanese company in the sense that it had a very inefficient, bloated balance sheet with a huge amount of net cash, which was the first source of undervaluation. It was trading at a very low multiple, probably half the multiple at which its peers were trading at. Some of that was reflective of the inefficient balance sheet, but also there were other factors, for example, poor communication, the fact that there was very limited research on the company, and that the business opportunities and the growth opportunities for the business were not widely understood by the market and by other investors. So we've been working with the management team. We became the largest shareholder of the company. We've been pushing on a number of different doors. We've addressed capital allocation by encouraging the company to reduce the cash pile by buying back more shares. We've also helped the company improve their investor relations, their communications to the market by pointing out certain narratives and certain areas of growth and just being better communicators of their story. And that has resulted in that gap, when you look at the multiple compared to the peers, in narrowing substantially.
Your team has experience in consulting, doesn't it? So this is not just a sort of balance sheet tidy up. You can help them in very detailed ways.
I mean, that's our key differentiator from many of our peers. It's very easy to go to a company and say you've got too much cash. That's why your share price is cheap. And anyway, it's my cash, so give it back to me. Companies have learned that in Japan, that they've got to be more efficient when it comes to their balance sheet. But really what they're interested in hearing about, what's bothering them, is how they can improve the profitability of their business. And to the extent that our team can help, first of all, it improves the relationship. It creates a more trusting partnership between us and the company. We're just not another antagonistic shareholder. We're actually a constructive partner. And we're helping them solve a problem that's keeping them awake at night, which is always helpful.
So hopefully they'll sleep easy. Let's bring this to life a bit now with a real-world example. We have AGT's investment in Japan's TSI Holdings. It's a small cap where engagement and governance reform were key. Let's take a look. We have a video.
TSI Holdings is a small cap Japanese company. They are an apparel company with a diversified range of brands ranging from male fashion, female fashion. They are a very typical company that we would normally look at. Apart from the fact that they are small cap and really undercovered within Japan, they are also cheap, trading at low valuations. AVI has been investing in Japan for 40 years. Japan looked cheap, overcapitalized, some of the companies were undermanaged. However, about 10 years ago, things started to really shift in terms of corporate governance, a code being introduced, and the advent of Abenomics. We felt that TSI Holdings was trading very cheaply and was deeply discounted. They had a really large portfolio of investment securities, and on top of that, they had a large portfolio of real estate and were being valued at next to nothing on their balance sheet, and we felt that they could do a lot more with that. AVI typically looks at a number of different things in terms of engagement points, but there were two areas that were really a focus for us. The first was operational improvements. They had way too many brands. They really needed to shrink down their portfolio. They needed to streamline their business, especially around logistics and warehousing. On the capital allocation side, we thought the real prize that wasn't being focused on by the market was their real estate. They had a lot of real estate that we valued at much higher than what they had it on in terms of their books. And just to be really sure, we got a third-party appraiser to come in, so we had even more increased confidence that they were being undervalued. We got them to agree to bring in a management consultancy firm to help them implement those changes and actually bring them about. So our position within TSI Holdings ended up being really large. We were actually the largest shareholder of the company. However, we recently sold out of it. The company had sold in the beginning of the year in January one building, and that one building was worth 30% of the market cap of the company. So the question then came about, what are they going to do with that money? We engaged with the company and we convinced them to do a buyback. So they did a 16% buyback about a month ago, and we sold our entire position into that buyback. And what that illustrates is that even if you're invested in a small cap company, even though there may be concerns about liquidity, there are ways for us to catalyze a liquidity event on our own. So since AGT first invested in TSI Holdings, the share price has gone up about 4 times. And we do get asked, what do we think was the biggest impact in terms of our engagement? What I do think AVI does differently is that instead of just focusing on capital allocation, which a lot of other investors do, we also focus on the operational side. And then on top of that, you have the capital allocation piece. So I think it's a really holistic view of the company that's important. There are also a few non-financial improvements that the company made, which we helped guide them through. They introduced an ESG policy, for example, and they also really focused on improving their investor relations. So much so that they went from having, quite weak IR to being awarded by the Tokyo Stock Exchange for their strong investor relations. I think AVI really excels and has built a history around investing off the beaten track, and TSI is an excellent example of that. It's a company that no one had really heard of, no one was really invested in, and yet it produced, with a little bit of help, some really excellent returns for investors.
So a very interesting example of how AGT has unlocked value and liquidity in small caps. I just want to zoom in quickly before we move on from Japan onto dividends. It's always struck us that even before this corporate governance drive, there was actually a reasonable case for Japan having a certain level of income at least. Has that greatly improved now, do you think?
It has improved. It's certainly one use of excess cash on the balance sheet. Payout ratios in general in Japan are lower than they are elsewhere in the world, and encouraging companies to increase their payout ratio as part of their drive towards greater capital efficiency has resonated with many companies, and it's been a palatable way of addressing capital inefficiency rather than taking all the cash and giving it back to you in one go.
Do they tend to, and do you suggest buybacks as well? I suppose anything that's pro-shareholder is good. What do they tend to go for?
They tend to go for a mix, I would say. Like management teams elsewhere in the world, they're hesitant to implement high payout ratios and be stuck with them. No board wants to cut the dividend. So a buyback gives them that flexibility. But slowly but surely, we've definitely seen a trend of companies being comfortable increasing their payout ratios.
Right. Now, I know that a major focus for AGT has been family-controlled companies. And these are incredibly complicated sometimes and rather difficult to understand. So perhaps, Wilfrid, could you take us through the case in favor and also how you avoid potential danger?
Sure. So family-controlled holding companies have kind of been at the bedrock of AGT since its inception. And we like them for a number of reasons, but they are, as we said, overlooked by other investors. They're often, as you said, complex beasts. So they might have dual share class structures, they might have cascade structures where you have a discount upon a discount. And investors typically don't like complexity, they like simplicity. So this can lead to a mispricing. They're typically not that well researched. So many of the holding companies in our portfolio and universe are covered by one or even no sell-side analysts. There's little incentive from investment banks to cover them. They're unlikely to raise equity, trading at wide discounts. They have low free floats. It's kind of an investment banker's nightmare in many ways. So other people aren't looking at them. That is inherently interesting to us. And they often own unlisted assets. We'll come on to talk about this later, I believe. But we can do some of our best work when we can build a differentiated view on an unlisted asset within a listed family-controlled holding company, and then look for some event or catalysts that can crystallize that value and bring the valuation to the fore. So we think they're kind of structurally inefficient, and we like to try and exploit that inefficiency. Again, we also like the alignment of interest. So the consensus view towards family-controlled companies, or controlled companies generally, is one of skepticism. But in fact, there's a lot of academic research that shows that such companies outperform in the long run. And we like the alignment of interest with thoughtful stewards of capital who can think in generations and not quarters. And if you look around Europe, there are many examples of these, be it the Agnelli family, their holding company Exor, which has compounded NAV at a very respectable rate since its inception, beating...
They do their optometry. Is that...
No, so Exor is the holding company of the Agnelli family, whose wealth emanates from...
I was thinking Exor Lutica.
Yes, the same country, but a different company. And so they own a portfolio of listed equities, principally Ferrari, Stellantis, and CNH Industrial. And you can buy those listed equities, plus a few other unlisted assets, today at about a 54–55% discount to NAV, which in our view is truly incredible. It's one of the widest discounts Exor has traded on in its history, and speaks to kind of investor apathy for these companies that aren't a large part of the index. As we said, we look away from the index, we look where others aren't. And as the world is focused in upon US equities generally and tech equities even more so, these overlooked opportunities are trading at very wide discounts, very low valuations. And meanwhile, the family continue to do many of the right things. They've raised capital in the portfolio, bought back shares with a tender offer at a wide discount. And we think that's incredibly attractive. And we like the alignment of interest with the family doing things good for the long term.
I always wonder with family-controlled companies whether investors are sometimes put off by gossip or drama that they read about in the papers. I've heard that often the second generation tends to make a mess of family-controlled companies. Do you think that's true?
So I think that the adage of that is probably there's a kernel of truth to it. The great thing for us is that many of the companies in our universe are now into their 6th, 7th, or 8th generations.
So they survived this.
They survived. They are the great survivors. And an important transition occurred probably for European holding companies maybe 20 or 25 years ago, that they transitioned to having professional management teams. And that's really imperative. So they maintain the ethos of the family.
From the long-term stewardship.
Yeah, so I mean, Investor AB in Sweden is probably a case study as one of the best holding companies in our view, and you're one of the best run. So they have the kind of the ethos and the long-termism of the family, but a professional management team with all the necessary skills to operate in the 21st century. So there might be salacious gossip in the press about some companies, but we try and avoid that and focus on the facts instead.
Okay, great. Let's drill down now into AGT's dealings with family-controlled companies. We have a video about D'Ieteren, which owns Belron, which is known in the UK as Autoglas.
D'Ieteren is a Belgian family-controlled holding company, now in its 7th generation. It's more than 200 years old. It's listed on Euronext in Brussels. And really, the family's wealth has been built up over time. Today, however, the value lies in a business called Belron. So whilst you might not have heard of Belron itself, I imagine you'll be familiar with its operating business in the UK, Autoglas. Autoglas repair, Autoglas replace. So as an investment, D'Ieteren is really indicative of our away from the index approach. So we're able to garner exposure to these unlisted businesses through a listed entity, which provides a very differentiated exposure in the portfolio. So within the D'Ieteren family, there are principally 2 branches of cousins. And in September 2024, one branch of Cousins wanted to buy out the other. To do this, they required capital, so D'Ieteren paid an extraordinary dividend of €74 per share. For many investors, they faced quite high tax rates on the dividends, and other investors were concerned about the corporate governance of this event. But we already took the other view. We thought when a holding company trading at a wide discount returns such a large portion of capital at NAV, that's inherently a good thing and should pull the discount to par. So we increased the position by more than 70% in the following weeks, and really this proved to be the right call. So in December, when the shares traded ex-dividend, the share price was about €200 per share. They traded ex of a dividend of 74, and rather than trading down to 126, they closed the next day north of 160. So we saw a large re-rating in the share price, and were really vindicated for our brave decision to add to the position. Belron is the global leader in vehicle glass repair, replacement and recalibration. And I stress recalibration. Windshields are becoming more complex. Most interestingly though, to do with sensors. So as we move towards driverless cars and ADAS camera systems, the cameras are fitted within the top of the windshield. So when you replace a windshield, the camera has to be recalibrated. If not, the car will veer off the side of the road. This has massively increased the technical specification of windshield repair and mean that Belron have continued to take market share. As the largest operator globally, Belron have significant scale advantages. This is most notable when it comes to their relationships with insurers, who provide about 70% of all jobs to them. As well as this, their other scale advantages include purchasing economies of scales. So they're one of the largest purchasers of vehicle glass globally, meaning they can negotiate good prices and in turn pass this on to the customer. D'Ieteren has been one of the largest contributors to AGT's performance over the last year. During this period, the company paid out the extraordinary dividend, and we added to the position considerably ahead of this. D'Ieteren trades at a wide discount of close to 50% to our estimated NAV. Clearly, Belron is at the crux of this, and in 2024, there was a transaction in Belron's equity at a 32 billion enterprise value. If you take that valuation, D'Ieteren's 50% stake is worth €222 per share. D'Ieteren shares currently trade at just 160, so that's a wide discount. So clearly the key question is what's going to make that discount narrow? In our view, the key here lies at Belron. We believe such transactions can really highlight the value to the market and lead investors to reappraise D'Ieteren and Belron's valuation. In terms of D'Ieteren, there are open questions around the portfolio composition and structure, particularly in the event of a Belron IPO, and investors will be interested to know about future capital allocation and whether some of the smaller assets, most notably PHE, can grow to become a larger part of the portfolio. D'Ieteren and Belron are really indicative of our differentiated approach and how we can find real gems of businesses hiding in plain sight. We think we do some of our best work looking at unlisted assets held by listed businesses and then look for events or catalysts that can make others wake up and see what we see.
Oh, that was very interesting. It reminds me I must get the crack in the windshield repaired. Since you sort of first engaged with D'Ieteren, has the discount narrowed? Have more and more people started to notice that this is actually a really good story and they really shouldn't have just glossed over it?
So the discount actually remains very wide. The NAV performance has been strong. We've earned good returns. But the discount remains wide today, as I said in the video, at close to 50%, which we think is very wide. We think a kind of structural or liquidity event with Belron is the key to unlocking that discount, as it should drive more interest in D'Ieteren shares and really prove out Belron's valuation.
Staying with wide discounts, we've seen a great deal of those in the investment trust sector, which is another thing that AGT likes to zoom in on. Again, you take a rather unusual approach compared to most funds by buying other investment trusts and trying to work very hard to close the discount. Why are you so keen on other investment trusts?
Well, we're keen on other investment trusts because it's just another illustration of potential inefficiencies. When you've got the ability to buy into a listed vehicle, owning a collection of assets, trading well below the value of those assets, that really interests us. And particularly when you've got illiquidity, lack of research, lack of investor interest, that just compounds the inefficiency. So in many cases, we see the opportunity for us to buy into a collection of assets worth £1 at 60, 70 pence, and to become a large and dominant shareholder, and to use that position on the shareholder register to really engage with the board of those investment trusts and the managers to help encourage them to address their discount, and really to benefit our shareholders by the double whammy of growth in the value of the NAV plus a narrowing of that discount.
You've been doing this for a long time, and recently Saba has sort of arrived at the party to try to drum up interest. Given their involvement, do you think we're making some progress on closing discounts, or is it seems like quite a long, depending on the sector, I suppose, it seems like quite a long campaign.
Yeah, well, things in the investment trust space do take quite a long time. It's been around for over 100 years. But I think we are making progress. I think Saba and others really have focused the minds of boards, of management, and other investors on the idea that it's not great to have trusts trading at wide discounts, and if those discounts are persistently wide, trusts have got to ask themselves the question: do they deserve to exist? Are they serving a purpose to their shareholders? And if not, ought they to be looking at alternatives?
Do you have a couple of examples of trusts where you feel you've been able to drive some positive change?
Yeah, when you look at our portfolio over the last few years, our exposure to investment trust has really focused on the alternative space. So we've had some listed private equity trusts, some infrastructure, some more growth capital type trusts. Those were the areas of the investment trust space that had the widest discounts at times over the last 12, 18 months, probably 40 to 50%. And those were areas that deterred other investors, and that really encouraged us. So we've had, I would say, quite a lot of success in that space, getting boards to think about capital allocation, the idea that sometimes a better use of the fund's limited capital is buying back shares on very wide discounts, which is very accretive to the NAV, rather than going on to make new investments. And we've definitely seen in the listed private equity space better attitudes towards capital allocation, more companies implementing share buybacks, and I think it's fair to say that we've played our part in that.
Yes, I was going to ask you about private equity, because when you talk to some private equity trusts, you get the impression that they're quite gung-ho, they're quite cheerful. They feel they've been able to sell certain things when they do sell at a decent price, and yet they're walking around with discounts to NAV of 30, 40% still. Do you think this disconnect is justified, or how will that play out, do you think?
Well, we'd agree it's not justified. And the reason why we've been positive on the sector is that you could see in many cases a private equity fund owning stakes in other funds where there's secondary transactions going on in those funds, and those are taking place at 5-10% discount to NAV, and yet the listed vehicle is trading at a 40% discount, and that's a disconnect. And certainly, whilst it's taking time, getting companies to buy back shares is, and in some cases to actually sell some of their underlying portfolio and using the proceeds to buy back shares, is another way of sending a message to the market that management and the board believe that there's a disconnect, there's an inefficiency here, and they're exploiting that to the advantage of shareholders.
Okay, good. Well, hopefully that will play out, but that will play out well. Let's now zoom out again. We are going to be a bit big picture and talk about off the beaten track. This fund is very much a value fund. You have done very well, actually, in the last decade without the Magnificent Seven in your portfolio. And so far, have you come to any assessment about what will be off the beaten track and what will be lucrative in the next few years that, again, isn't the Mag 7, since you're not growth orientated in that way?
Well, it's an interesting question. I mean, we're finding value across the board, and typically we're finding value where others aren't looking. So to the extent that most investors around the world are looking at the Mag 7 and we're not, what that has meant is that huge parts of the world have been neglected and overlooked. Small cap is an example, the UK is an example. The most recent reflection of that in our portfolio has been the growing interest in what's going on in Korea. Korea is a relatively small market in the global context. It makes up 1% of the MSCI world. And over the last 3 or 4 months, we've been increasing AGT's exposure so that it's around 8% today. So in some terms, that's a big allocation, a big overweight. And what's interesting about Korea is that it's certainly one of the cheapest markets in the world. It's really been neglected by investors for years. Nobody's really cared about it. It's a small, insignificant market. Valuations are really low. And recently, the government and the regulators there have been looking at what's gone on in Japan for the past 10 years and thinking that they could do with a bit of that in Korea. So we've seen the new president coming in. He's introduced some laws and regulations, as well as some incentives to really address the undervaluation in the market and to force companies to address some of the inefficiencies, to focus on minority shareholder rights, and to encourage broader ownership of the stock market. So the market's gone up quite a lot over the last few months in anticipation of that, but the market is still very cheap. We own 7 or 8 different companies there. Discounts are probably around 50 to 60%, so pretty wide in the context of our overall portfolio. And coupled with a catalyst of real regulatory change there, it's certainly one of the most exciting opportunities we see today.
Has the corporate governance improvement campaign, so specifically targeted the kaibols, as they call them, the family-controlled holdings? There were, I think, like in Japan, there are lots of cross-holdings. Is there a specific emphasis on that, or is it just more of perhaps encouraging the grassroots to get companies to be more responsive?
There is definitely a focus on limiting the power of those chaebols and addressing one of the sources of the lack of demand for stock market ownership in Korea. One of the reasons that local investors have been deterred from investing in the market is the fact that so much of the market is controlled by those families, and those families run these businesses as personal fiefdoms and don't care about minority shareholders. So just an example of new regulation coming into force in Korea is that when shareholders are asked to vote for the appointment of independent directors or independent auditors, under the new guidelines, under the new regulations, those votes will be limited to 3%, regardless of how much of a company you own. And that's just a way of limiting the power of controlling shareholders to 3% in those instances, as a way of sending a message that we really do care about minority shareholders, and we are going to address some of that abusive power that exists in the market.
Okay, that's interesting. Well, hopefully the famous Korea discount will dwindle a tad. A lot of the Asian export-orientated economies have been worried about tariffs and all that. Has that settled down now in the Korean context, and to an extent?
I think everybody is worried about tariffs. By definition, they are unpredictable.
Yeah, sort of might keep the discount wider than it needs to.
Yeah, absolutely. Companies, investors around the world don't like things that are unpredictable. A lot of our companies in Korea are actually domestically focused. They are immune to an extent from tariffs, and that's interesting. And there are also other measures being implemented in the market that address those inefficiencies and that discount.
Right, brilliant. I think that brings us to the end of the overview. Thank you very much to you, Joe, and to you, Wilfrid, for this interview. It's been very interesting to delve into a fund that ferrets out value around the world in sectors and markets that are often overlooked, such as investment trusts and family-controlled holdings. Finding value is one thing, as we always say at MoneyWeek, but profiting from it is another. Now, MoneyWeek liked Japan for years, but cheap markets and stocks tend to stay cheap without a catalyst for change. Japan began to change under Shinzo Abe's corporate governance reforms in 2013, and now Korea appears to be going the same way. This trust, meanwhile, not only finds value across the world, but uses activism to provide its own catalyst, which crystallizes the value. It should certainly stay among the 6 funds in the MoneyWeek investment trust portfolio for some time. Now, let's take some questions from the audience. I have some here on my iPad. What happens when engagement with a company doesn't work?
It's a good question. It certainly doesn't always work. The starting point for us is, always we want to be constructive, we want to be friendly, and that means we want to keep the engagement quite private. So when we find that it's not being effective, companies are not responding, the first reaction is to up the pressure, up the ante by making that engagement public. So when you do see a public campaign from us, you should assume that there's always been a private campaign before that, and to the extent that hasn't been fruitful, we move up to a public campaign. That sometimes works, and it also sometimes doesn't work. And after a while of making an effort, if we find that our engagement really doesn't work, then we have to. It's like any investment that's not working. We have to reevaluate, reconsider whether we've made a mistake, and sometimes we just have to move on.
I think the other point to tease out in this is perhaps a focus on underlying business quality. So whilst many so-called value investors are trying to buy that pound of assets for 70 pence, if that pound of assets is dwindling and that's going to be 90 pence next year, I mean, you've got a race against time where time isn't your friend, but we're really trying to invest in situations where time is your friend and the compounding can occur. So even if the engagement proves harder than we expected, we should be able to earn a decent return, notwithstanding that fact.
That's good, thanks. We have another one here from the audience. It says, the evidence for passive investing is pretty compelling in terms of beating nearly all active funds and trusts over time. What makes it different this time, and why AGT specifically?
Well, I think the evidence kind of en masse for passive is highly compelling, and for many investors that could be a suitable option. Your average fund manager will underperform. All we can talk about is what we've achieved over the last 40 years, which is outperformance of a couple of 100 basis points per annum. And as viewers will well know, that really compounds up over time to lead to really quite significant long-term outperformance. So in our case, I think we are doing something truly different. Our approach is kind of antithetical to passive, and we believe that doing something truly different has the potential to produce truly different returns. And history shows that works, and with a bit of luck on our side, that will keep working in the future, as we believe that the sources of that are structural in nature.
Yes, we always...
Passive hasn't really been tested. For the last 15 years, there's been this exponential boom in passive ownership. By definition, what that means is more and more capital, more and more investors own an ever shrinking number of companies. Now, what happens when those companies perhaps reverse direction and fall in value? Yes, passive investor will by definition always match the benchmark, but to the extent that, as we said earlier, the valuations of those companies around the world that aren't owned to such a great extent by passive funds, and they look compellingly cheap, that could be their moment to shine.
That's true. We always tell readers, of course, it's great to have passive and generally the numbers are with you. But when it comes to the obscure stuff, the illiquid stuff, then it's really important to have some activity, both in emerging markets and in developed ones. I think especially given the structure of investment trusts, you can own, really assets that you might not be able to get out of very quickly at one remove, as it were. And that's something that we've always been very keen on. I'm talking of not being tested, Joe. We have a question here where it says, there are currently lots of worries in the media suggesting there could be a blow-up in equity markets. Does this worry you? And if it happens, how do you think it will affect you and your portfolio?
Yeah, it is interesting. It certainly does feel as if the growing consensus is that there's excess in certain parts of the market and that we're overdue a correction. We're in the middle of October, a notorious month for stock markets. What I've learned over the years is that just because everybody's talking about a correction certainly doesn't guarantee that there's going to be one. Markets climb a wall of worry, but it certainly does pay to think about valuations, because it's always at times, and particularly when things come out of left field, we don't know what's going to be a cause for the stampede out the markets or a reversal in sentiment. It's always at those points in time investors start looking at what they own and questioning, does it make sense to own a company at 100 times earnings, for example, or a company that's never going to make a profit? So valuation matters, but market timing is a futile exercise, and trying to predict when the market is going to crash is notoriously difficult. We are an equity fund. There's a lot of beta, to use the parlance, in our portfolio. So, and we're long only. So you would expect that if markets around the world were to correct, you'd see a correction in our NAV as well. Our stocks trade on very wide discounts, certainly at the wider end of the historic range, which I think will provide some protection. maybe not in the moment of that correction, but certainly as the dust settles on it, I think we will see a narrowing of the discount.
People start looking at quality again after the panic. Yeah.
Well, people start looking at quality. People confidence comes back. People start sifting through the mess really and looking for value. And owning great quality businesses on 50% discounts at various points in time is particularly where those valuations have corrected, is really an attractive thing to do. So whilst the short-term impact of a correction is never pretty, I think that coming out of it, we will benefit from the double whammy of both appreciation in valuations, but also very compelling tailwind of discount contraction.
Yes. We always, I mean, there's a lot of talk about, the valuations aren't nearly as crazy as during the dot-com bubble, but that doesn't necessarily mean they aren't a bit over the top. Actually, on that subject, I was going to ask you if you have terrible trouble getting your message out there during times when growth is hugely fashionable. Sometimes in investment, fashion is everything. People just don't think about things that are out of the spotlight. Of course, your fund is very much designed to go outside the spotlight, but is it harder to, get your message across at times of, when everyone's getting excited about AI?
Well, I think the beauty of what we do is that many investors know what we do and they understand what we do. And they can see that there's a lot of excitement around the Mag 7, a lot of excitement around AI companies, and they don't expect AVI to own those kind of businesses. So having made a name for ourselves and built a reputation of doing something differentiated, something away from the index, investors are fairly comfortable knowing that our place in the portfolio is built around the idea that that will give them something different, genuinely different. So to that extent, it's an advantage.
We have here another more specific question about Gerresheimer. How has the recent profit warning affected your view of the stock? How do you stay confident with diminished growth, high debt, and limited visibility? It's taking quite a lot for granted, that one.
So
is that reasonable?
So the recent profit warning highlights a number of issues that face the business, both in terms of its internal controls, the way in which they monitor how the business is performing. But we're encouraged with the new CFO. As investors, as listeners might know, we sent a public letter to the supervisory board back in June. One of the key tenets of that was for new financial leadership, and since then, a new CEO has been brought in. And we're encouraged that under his leadership, there are green shoots for better performance and better management of the business from a financial perspective. But the business faces many issues. It does have high debt. It has some economic sensitivity in the molded glass parts of the business. And we really think time's of the essence for the supervisory board and for the management team to unlock and realize the immense value that is there. With the shares having fallen so much that the valuation is really very depressed. But yeah, the business faces issues that need to be fixed.
Do you have a rule of thumb about how profit warning? Everyone always says that someone has to keep a close eye on things, and a second profit warning is a misfortune, or one's a misfortune, and two is a coincidence, and three is enemy action or something.
Well, three seems to be the magic number often, but Gerresheimer have been kind of profit warning consistent in the worst of ways over the last 12 months, and it was one of those profit warnings that first piqued our interest. But clearly, profit warnings are not a useful thing for a company to have, and highlight issues that need to be fixed.
We have a question here about you've been very successful for many years. As we are all mortal, what succession plan is in place for the future of AGT AVI?
Well, indeed. So we're a large investment team now. We are 14 people within AVI. So it's certainly not about me. You've met Wilfrid here today, who's a senior analyst. There are other senior analysts back in the office, and there's a whole breadth of knowledge and expertise built around the team. And certainly any succession will be built around people who I've worked with for many years, people who I trust, and working with the board, we've got a firm succession plan.
Okay, so all in hand. We have one here about managing money in ITs. What is Joe's view on investment trusts enhancing their dividends based on capital reserves over earnings?
Yeah, I think that investment trusts can clearly do that, but I think it's a bit of smoke and mirrors. And it's usually designed to address the discount, to appeal to a certain subsector of potential shareholders who favour income, but it's not real income. And I think that I think certainly one of the advantages of the investment trust space is the requirement to pay out the majority of income and the ability to use reserves to smooth that. I think that's a good thing, but to create a wholly different income profile out of capital, I think that's not a good thing.
Okay, so it's good to hear. We have a more general one here about your strategy. How do you avoid value traps away from the index?
Yeah,
you might want to just reiterate. You don't actually track. You don't have a benchmark index as such.
Well, the board does have a benchmark that it uses to measure our performance. It is the MSCI World Index.
Okay, the world one. The other one with emerging markets in it.
Yeah, it's the all-country index, the all-country world index. And it's really designed to reflect the fact that investors can choose, when they invest in the global trusts, for example, the global growth investment trust sector, they can choose any number of investment trusts, all of which can invest globally. We can invest globally. The fact that we choose to disregard large parts of the market shouldn't really preclude the fact that at the end of the day, over a multi-year period, we ought to be beating the world index. So yeah, we do have a world index. How we avoid value traps is really by asking ourselves a series of questions. The starting point is we're told that stock markets are efficient, and therefore, if that's the case, when you see something trading at a discount, the natural response should be, well, the market's being very efficient, very clever about giving you a warning. If something's worth £1 and it's trading at 50 pence, it's not really worth £1, it's probably worth 50 pence. So we really start probing that. Is the market really being efficient, or what is the market missing? We're also looking for situations, as Wilfrid just described earlier, where we think businesses are going to grow in value. So notwithstanding the fact of whether or not we can achieve something on the discount, the actual growth in the value of the business can deliver a return. And sometimes that works and sometimes it doesn't work. And when our experience is negative, it's poor, the share price isn't going up, the discount is widening, then we have to constantly reevaluate, reassess whether we were wrong, whether the market was indeed being efficient and we have actually ended up owning a value trap rather than an exciting opportunity. And it's that real process of constantly reevaluating the investment thesis based upon our experience in the market through that prism of thinking, is the market efficient or not, that has led us not to avoid all value traps. And clearly we have hit some traps, but for the most part, we've avoided many.
So it's pivotal to be able to engage with the company and actually get them to think about different things, which will be one of the main ways you can avoid them. Right, I think that brings us to the end. I think we're running out of time. So apologies if we didn't have time to get to your question, but please do reach out to us and we'll be sure to get back to you directly. Thank you for your time. Just remains for me to thank Wilfrid and Joe very much, and I'll see you next time. Thank you. Bye-bye.